Hello, and welcome to Wealth Management Insights. I'm Monica Guerra, Head of U.S. Policy for Morgan Stanley Wealth Management, and I'm recording this audiocast on Wednesday, August 20th, from our studio in Purchase, New York. Today, we're diving into the recent developments in stablecoin legislation and their potential impacts on the financial markets. The 119th Congress is shaping up to be the most pro-crypto in history, with 66% of House members and 59% of Senate members showing support for the crypto industry. This shift is due not only to global competition, but also to the industry's involvement in electoral politics. Since 2020, crypto industry political donations have grown exponentially and accounted for 44% of all corporate donations during the 2024 election cycle. This political backing has paved the way for the passage of the Genius Act, signed into law by President Trump on July 18th. The Genius Act establishes a regulatory framework for stablecoin issuers, requiring them to be backed one-to-one by U.S. Treasury and U.S. dollar reserves. In this case, more regulation is viewed favorably by the industry, promoting the adoption of U.S. dollar-pegged stablecoins. The Genius Act sets new industry standards outlining capital requirements, liquidity, and anti-money laundering obligations. This increased legal guidance is expected to boost investor confidence and increase the adoption of stablecoins. Looking ahead, the Clarity Act is pending in the Senate and aims to further define the regulatory framework of various digital assets, their custodians, and introduce rules for financial services activities. That said, we expect the bill will be subject to change as the Senate has yet to consider the proposal. The macroeconomic implications of these legislative developments are significant. The U.S. Treasury estimates that stablecoin supply could increase to over $2 trillion by 2028, up from $230 billion today. This surge is expected to drive greater demand for U.S. dollar and front-end U.S. Treasuries, potentially pushing down yields. Stablecoins are among the largest external holders of U.S. Treasuries globally, with holdings increasing by 56% between 2023 and 2025. This trend is likely to continue with stablecoin-driven demand concentrating on short-term T-bills, aligning with recent Treasury issuance strategies. In the equity markets, crypto-innovative and crypto-enabling stocks have outperformed the S&P 500, reflecting investor optimism about the future of digital assets, while traditional transaction and payment processors may face challenges as stablecoin adoption grows. Zooming out, the Genius Act and pending Clarity Act represent significant steps towards regulatory guidance in the stablecoin market. These developments are expected to foster innovation and adoption, driving demand for U.S. Treasuries and U.S. dollar. As the landscape evolves, investors and financial advisors should stay informed about these changes and their potential impact on the markets. As always, thank you for listening. For a more in-depth discussion at the intersection of policy, markets, and the economy, please ask your Morgan Stanley financial advisor for copies of our most recent U.S. Policy Pulse report.